Hi everybody and welcome to the second video in this series of exploring financial markets. In the previous video, what we did was we looked at the different roles of financial markets. So the importance of having the ability to save, to lend, to facilitate the exchange of goods and services, forward markets and equities markets. What we're going to be looking at in this video are the failures of financial markets. Now, in theme one, we looked at the topic market failure, and that was when the market mechanism, so the price mechanism, so that idea of supply and demand, is not maximizing economic welfare. Okay, so at the equilibrium point, supply and demand were not maximizing economic welfare in the marketplace. So what we therefore have is a misallocation of resources in financial markets created by the market mechanism. Okay, now there are 5 key financial market failures that you need to be aware about. We have asymmetric information, externalities, moral hazard, speculation and market bubbles, and market. Right, now the first one that I want to talk about is asymmetric information. Now remember, all asymmetric information is it's where some people within the market have got more knowledge about the products that have been sold or bought than what other people have in that marketplace. And that often means that some people within that market can often be exploited. If you lack the information, then the other person in the market could use that to their advantage to exploit people. It could also mean that the people that are in the market, if they haven't got the full information, they find it difficult to act rationally. Okay, now you've got here some examples of asymmetric information in financial markets. Now look at the first one. Borrowers know more about their ability to repay than lenders. From banks, it seems to be quite difficult for lenders to work out whether the people borrowing from them will have the ability to repay them loans. Okay, so someone, for example, might know their income isn't particularly secure for the next 6 or 12 months. And that might make repayments quite difficult to keep up with. But if lenders haven't got that information, it's going to be very difficult for lenders to assess who they should be lending their money to and what interest rate people should be paying. Because if we can't assess the risk properly, it's quite difficult to put the right interest rate on loans given to borrowers. Now, that could also, of course, apply to insurance markets. So it's quite difficult for insurers to fully assess how risky people are in markets. So again, that makes it difficult how much people pay for insurance. So that is an example of asymmetric information. What makes that problem even worse is that when people have insurance, they often become more risky because they've been insured against that risk. So it's quite difficult for insurers to then calculate exactly how much these people should pay for that insurance. Next one, regulators having less knowledge than banks. So we're looking at financial regulation in a future video, how regulators make sure that banks are doing things fairly, they're not exploiting people. But the problem is that often the people within the banks have got information about what they're doing, how they're performing, which they can often hide from regulators. Well, that makes it very difficult for regulators to accurately regulate these different banks. Now, that can also then potentially be a source of government failure at some point in the future. We've mentioned the one about insurance, the third one down. Look at the one now, payment protection insurance, PPI. Now, the idea is here, this was a big mis-selling scandal from several years ago. And the idea was when people took on board certain loans, this could be buying a new car, it could be even buying a mortgage, it could be buying a sofa, or it could just be taking out a general loan from the bank. What banks often did was they crammed down people's throats payment protection insurance. Now, the idea was the people that sold the loans were given commission for how many people they signed up for payment protection insurance. Now, what this meant was the people that took out the payment protection insurance, if they were to suddenly lose their jobs or lose their incomes, then the idea would be the insurance would keep on making them repayments for people. So, for example, £1,000 to buy a car. the monthly repayment might be £200 on that car. Well, the idea would be that if your income was to suddenly drop or disappear, the payment protection insurance would keep on making them repayments for you. Now, the problem was that a lot of people that took out payment protection insurance were missold this insurance. So quite often people were kind of encouraged to take out the PPI, but they weren't covered. If, for example, their income was to drop due to the type of work they might be completing. So lots of self-employed people struggle because of this. But also there were a lot of people that took out PPI that weren't ultimately aware that they're taking it out in the first place. So the idea was, you might just automatically be signed up to it without actually being conscious about that or not. So you were paying for a product that you might never use or be aware of in the first place. When people took out PPI as well, they were often not made aware they could shop around and get that insurance cheaper with a different provider. Now, another example of asymmetric information is something that we call securitization. And this was what led to the financial crisis. Now, we're going to be exploring this in more detail together in class, but the idea was that big financial firms like banks, they would bundle up lots and lots of mortgages together into a financial product. These would then be sold on to investment banks across the world. Now, the problem was when people bought these products, what they thought they were buying was a good bundle of mortgages, with the idea being that when people take on board mortgages, if they were to fall on financial hardship, it's the first thing they would pay off. So it was seen as a really, really low risk investment that these investment banks were buying. Now, what the investment banks weren't made aware of, though, is that tucked away inside these big bundles of mortgages were subprime mortgages. So the idea was that banks had been lending to people who had a very bad financial credit score. And the idea was these people were high risk of defaulting on their mortgages. But the people that bought these big bundles of mortgages didn't know these subprime mortgages were tucked away in these big mortgage packages. Okay, now that meant that the people buying these products weren't really aware of what they were buying. And this actually led to the financial collapse of financial systems across the world, which caused the 2008 recession. And again, that is something we'll look at in more detail together in class. Now, the next one is externalities. Now, hopefully what you remember is that negative externalities are when impacts of a market, so the interactions of buyers and sellers, create bad impacts for people outside of a marketplace. Okay, now when we think about the financial recession of 2008, that was a problem that was created in the mortgage market across the world. But then that created bad impacts on people outside of that marketplace. So what it did was it led to a massive drop in GDP due to a big reduction in the ability to borrow money across the world. That led to a massive growth in unemployment. House prices fell, which meant that people lost lots of wealth. And this created big drops in economic development across the world. It also required lots and lots of very expensive government bailouts to keep these businesses going. Now, this meant for the next 10 years or so, we had in Britain fiscal austerity, where the government tried to reduce how much debt that we had. And that meant that people like me, teachers, were more or less given pay freezes to reduce government debt over time. So, guys, the idea is then, what happens is that when problems exist in financial markets, often they spill over into different markets and economies across the world. So, for example, problems created in the build-up to the 2008 financial crash meant that I didn't really get a proper pay rise for 10 years. It meant that people saw their house prices fall. It meant that millions of people across the world lost their jobs. So these were the bad impacts on people outside of that marketplace. Now, the next one is something that we call market rigging. Now, what we're doing here is big financial firms, they can often collude or work together. Remember, financial firms will exist to generate profit. So sometimes by working together, in other words, not competing with each other, they can manipulate prices to suit themselves. So what you could do, for example, if you've got lots of people that hold their money in your banks, you could technically work together to rig interest rates. You could force interest rates downwards to reduce the payments you've got to give to them people that hold their money in your banks. You could also technically rig share prices. So, for example, you might be able to force a particular share price upwards, and that might be a share that you own. Then you can potentially cash in and make a fortune on them. Or you might look to manipulate exchange rates, again, to generate profit. So what you're doing, you're using your market power to rig different prices in financial markets, interest rates, share prices, or exchange rates. And what we'll be looking at together in class will be something called the LIBOR scandal. So a good example of where big financial firms, they work together to rig interest rates in their favour. Now, the final one is something called speculation and market bubbles. Now, the idea is here, what financial markets can do, they can force the price of an asset way beyond its true value. And that can then lead to the collapse of that particular financial asset. So a good example, in the build up to the Wall Street crash, share prices were driven up way beyond their true level. Now, what happened was it was herding behavior. As soon as a few people started investing in the stock market, the share price started to grow, and then everyone thought it was a sure recipe for making lots and lots of money. So everyone jumped on that bandwagon and invested heavily into the stock market, and that pushed up share prices way beyond what them companies were truly worth. And that led to a huge crash in the stock market. Okay, people started realizing these shares were overvalued and started selling these different financial assets. And the idea was, millions of people across America lost an absolute fortune from this, and it created the Great Depression. So the externalities that came out of that was it led to massive growth in poverty and a reduction in living standards across America. The most recent one was the housing market bubble, where we had this big growth in house prices caused by an excessive level of borrowing being available to buy property. And the idea was house prices went up way beyond their true market value, really. And then the idea was people realised, and there was a big crash in house prices. Millions of people ended up in negative equity, so they bought a house which was suddenly worth less than what they borrowed. So they owed extra money on their mortgage on top of what their property was worth. Millions of people, were almost declared bankrupt because of this as well. Couldn't afford high payments to their house back to the banks. They then lost fortunes on this. So speculation and market bubbles, everyone. Right, everyone. Now, just to wrap up this video, we've got one more example of financial market failure. This is moral hazard. Now, what a moral hazard is, it's where an economic agent, that could be a household, a firm, or a government technically, they make decisions which are in their own interest. But what they're aware of is it will then potentially create negative risks for other people. In other words, if something bad happens, the costs will not be for them, they'll have bad impacts on other people. So it's a bit like an externality problem. Okay, so to give you an example, what the big banks knew in the build up to the financial crash is that they were massively important in the UK economy. They were big employers, big tax contributors, and they often underpinned the success of the UK's trading services on the current account. So what these big financial firms knew was that if they took big risks and these risks paid off, they would be even more successful, even more profitable. But the idea was if things went wrong and these investments didn't work, then the idea would be that the government would bail them out. So they couldn't really lose either way. If they do really well from big risks, they make loads of profit. But if these big investments fail, then the government will bail these big financial institutions outwards. This is called the too big to fail argument. Okay, so the idea is that big financial firms, what they're aware of is that when something bad happens, this will impact badly on other people, not so much on them. You can even argue when people take on board insurance, we also suffer from moral hazard. What we know then is when we take out, say, car insurance, that if we were to involve ourselves in a car accident, then it would be the insurer that pays the cost and not us. Okay, so that technically makes people more risky. So, it's almost encouraging more excessive risk taking if people have this kind of insurance or backup. Now you've got another example here. Look at this, speculators. Now people that make money in financial markets are often encouraged to take short-term risks. So look at this example. E.g., imagine a risky strategy generates potentially £1 million per year, and that works for 5 years. But then in year 6, the strategy fails and £20 million is lost. Now the investor will still walk away with the £5 million from the 5 years of that risky investment working away, but they will then leave that £20 million loss to the business that they work for, or the government to bail them out. Okay, so it's encouraging excessive risk taking. If it works, you bank the profits. If it doesn't work, you walk away and leave someone else to pick up the pieces. Right, everyone. Now, just to wrap up this video, what I would now like to do is to think about these questions. Define the term market failure, link it towards financial markets, and then B, try and get down a really good explanation of the following types of financial market failure: asymmetric information, externalities, market rigging, speculation and market bubbles, and moral hazard. And these will be things that we explore together in class. Thank you very much.